investors think that cash is safe, and they don't pay much attention to inflation. And then what happens is they get inflation and they realize that if I'm holding cash, I'm losing buying power. So then they shift, they sell out their cash, or they sell out their bonds, and they put that into other things. And when they do that, that also contributes to inflation. Changes like that also happen in a lot of ways, like cost of living increases in compensation. You know, where in the past, when they don't worry about inflation, then they don't think about, do I have an inflation-linked contract for my work? Or do I have enough inflation assets? It might be, do I need to buy, I'm going to store my money in a house, or I might store my thing. And so that pendulum swing from one mindset and one positioning to another mindset and another positioning in the early stages tends to be self-reinforcing. Those actions produce more inflation and more inflation psychology until that goes to the opposite extreme. You know, like in the 1970s, people were surprised about what happened because they weren't used to inflation much. Then you had the inflation, and in the beginning, it swung. And then at the end of it, they said inflation will never end, and everybody's positioned for it never ending. And then, of course, what happens is it's so bad that then the central bank goes the opposite extreme, and then they get surprised. And so the 80s was a period which was the exact opposite of the 70s, where you have falling inflation, high real interest rates, and so on. And so the worst assets to own in the 70s were bonds, and the best assets to own in the 80s were bonds. So you see these the best assets to not own, that's the most important thing, I think, is cash. And quoted, cash is trash. There will be a tightening here for the time being, and that tightening will have an effect. It'll hurt asset prices and so on. But cash is not the asset to own, and bonds are not good to own, in my opinion, because it's debt. It's owning somebody's debt, and you won't get a return. Think of it: the interest rate will not reach the inflation rate. So that's the problem. So you'll have that one. Then what you have to have, I think, most importantly, is a well-diversified portfolio of other assets. Diversification is a very powerful tool because it can reduce risks without reducing expected returns. Now, there's lots of ways of getting what you think good investments are. They might be things you know about and the local businesses and so on, or they might be stocks, or they could be maybe a little gold, or maybe a little bit foreign investing. Diversification is very important to do that in a balanced way. So I would generally say that would be what I would recommend. How many weeks could I live if I lost my income? And I started counting in weeks, and I would try to go out, because if I got hit, so I think that's the way to do it. You know, you start to count how many weeks. Can it be a month? Can a year? Can I get up to a year? I didn't like debt because of the fact that there's an obligation, and it's like, oh, if I get, then I'm going to be drowning. I'm trying to keep my head against water. This is just my own bias. But anyway, count how many you can, and then assume that its buying power over the next number of years can fall by 3 or 4% a year, or if you put it in a risky investment, like stocks or something, it can fall by more. So cut that number maybe in half, and have twice as much, because you have to understand that that's your freedom. That is your safety. So that first band, you must take care of. That first band, take care of that. Once you get past that and you feel, okay, I could take care of my family and I could take care of my in a worst case scenario. Then you have the freedom to then take other kinds of risks. But when you're building that portfolio, it's the same thing as when you have a lot of portfolio past that, just you want to diversify well. Because you could see what happens to the markets. Every market, stock market, bond market, most markets have had times where they've gone down over an extended period, 60 or 70%. So in buying power. So I think diversify, count that and build it and realize that's your saving. One thing I do for my kids and grandkids, and always did, or as long as I could start to afford it, was for every holiday, like Christmas or their birthday, I would give them a gold coin. And I said, I never want you to sell that gold coin until there's an emergency, a real emergency, never because you want to buy things. And the reason I did that, and they'll build over a period of time, that'll build something. And I said, don't even sell it. You pass it to your kids unless there's an emergency. Okay. And so you're building that savings, because I think we so easily spend so much money on junk, so anything that I would give them, whatever it would be, I don't know, a piece of clothing, a thingamajig, a toy or something,
right,
will probably be gone in a year.
Yeah.
Okay. And so the power of saving and that resource, the relief it gives you and the power it gives you is so great. So yes, save it, diversify it, to find individual bets that are diversifying, that your return will equal the average of those returns, but your risk can be cut by 80%. If you say, if the worst case happened, what would that look like? And I'm telling you, like I'm saying, that could be, that the worst cases when you look at that is something like 60 or 70% in buying power, whether that's stocks or bonds. Okay, that's what the risk looks like. However, if you do that with uncorrelated investments, when one goes up, like when commodities go up, bonds go down, or that kind of thing, and you balance things, then you find some part goes up and another part when the other part goes down. And by doing that, you can reduce the risk without reducing the return. Investments are typically those things that you're closest to, and they fall into two types. Those that affect your living standards, like I think owning a house or an apartment or your residence, it affects your life a lot. And the cost of it is not the cost of it. In other words, you buy it at a certain price. It's not like the thing that goes away and you consume, so you'll sell it at a certain price. And probably you'll modify it over a period of time. You'll make things, and it produces kind of a forced savings that also brings you joy and brings you a better environment, generally speaking. So I was just recently asked by a young couple, should they buy that? I forgot, it was a little house or apartment, or should they not? And then they sort of say, if I don't do that, I can travel more. Okay. But the travel will go away as an asset. Okay. So just be mindful where that will save, and think about also the joy that the house brings you. So I sort of think that that's generally a good thing to do, thinking about the total return.